Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's TPO live trade session. This is the beautiful Clearwater Beach. I took this 4 or 5 years ago. It was as you see it. It was a stunning, stunning sight. Welcome. If you are new on the call, we're going to get right into things here pretty quick. I will give you an update on the trade partner. I know many of you have asked about this. When's it going to be ready? And it is almost there. I received the last information that I need to go over today. Haven't had a chance to do that yet. So it is coming very, very quickly. And I will have a video on that, webinar/video on that very soon. If you're not familiar, we're in a unique situation where we actually have the ability to sell publicly trade partner stock. So you can actually be a part owner of trade partner. SEC laws have allowed small companies like myself to be able to do this through certain portals, and so that's almost complete. It's been quite the effort to get everything to this point, but we are almost there. All right, so for those that are new on the call, I do want to welcome you. And I also want to warn you that if this is your first call, or even maybe your second call or third call, I do not explain everything about every aspect of these trades that we're going to be looking at today. It's impossible for me to do so. You'll see me reference these, you'll see me talk about them, and unfortunately, there's just too much to be able to cover in 1 hour and take trades. So do not get to the end of this call and say, well, I don't understand anything, it's worthless. That would be a huge, huge mistake on your part. These calls are meant to be cumulative. So the more you attend, the more you're going to learn, the more you're going to feel comfortable with it. It's only a matter of exposure. And I promise you, you'll start to understand them. It might take you a couple of 3 months. For some, it might take longer than that, but it is well worth it. So having said that, I also want to warn you that these trades that we are going to be talking about today are fantastic. However, they're not the holy grail. There are no certainties in the market. We're going to be talking about high probabilities, but probabilities are not certainties. And so because of that, you need to make sure that you start small. You want to make sure that you're not reckless with how you put these trades together, and you certainly want to make sure that you follow instructions. Unless you absolutely know, if you don't follow the instruction, you absolutely know what the ramifications of what you're doing are. So some of these trades provide tremendous probabilities, but if you make a mistake, or if you haven't accounted for everything and you go big on your first trade or first couple of trades or whatever, and you happen to make a mistake, it's going to cost you, or it could cost you. And you don't want to put yourself in that position, and nor do you need to, because compounding is why we're doing this. We're not doing this because these trades are going to make you a millionaire in a couple of years, because they won't, outside of compounding. You have to understand the compounding. That's where the power is. That's where wealth is built. It is not in the underlying strategy. The strategy is necessary, but the bulk of the wealth that you ever build in trading is going to be based on the compounding. And so on some of these trades, you can compound pretty efficiently. So much so that if you can average $100 a week after just 6 months, you're talking about growing your small account by $30,000. And if you can continue to average that over a course of 5 years, you're talking about multi-million-dollar account. And this is math. It's not if you can average $100 a week. It is math. And so some of you might be saying, okay, well, that shouldn't be too hard. Well, it's harder than you think to average $100 a week. You probably are not going to start off when you decide to start trading. You're probably not going to start off averaging $100 a week. You're going to probably start off. In fact, what I tell people is you need to start. Your first goal needs to be $20 a week. If you can do $20 a week and compound $20 a week, and that's it, you're talking about growing your account faster than the fastest, most ballistic stock that we've seen over the last 5 to 7 years, which was Netflix. And I actually think Tesla might be on its heels a little bit. But nonetheless, what's the probability of you going out and picking the next ballistic stock and holding on to it for the next 5 to 7 years? Not very good. And I'll tell you something else too. This is so much better that even if you could do that, if you had a choice and you knew that Netflix was going to go up another, I mean, absolutely knew it was going to go up another however many percent it went up. Or you could do this. I would still do this. And you know why? Because when you buy Netflix and you take your $5,000 account and it goes to 100,000 or whatever, guess what? It can come right back down just as fast. But with this is a completely different ballgame. So both on the way up, and even if you start doing really bad, the drop on the way down is going to be slower. So that's compounding. It is the money management, absolutely number one key importance. I also have one other announcement that I want to make on this. That I'm gonna make it tentatively. So we are about to release Performance One online. Performance One is my money management compounding program, online app, if you will, to help traders better implement money management. So if you are absolutely familiar, if you've gone through my course, if you understand the compounding, then you're going to be the first one that's going to get access to this, because we're going to push it into client user testing, basically, is what this is called. So that's something that if that's something you want to be a part of, you let us know and we'll make sure you get first on the list. However, if you're not familiar with the money management, you don't understand the principles, you're going to be wasting your time to begin with. So don't request it unless you understand it. All right, let's move forward. We are in, I want to go back to the option insanity first, as we discuss these trades. This is an option insanity trade that I've had on for a couple of weeks now. I put it on at 350 credit, and this one is actually trading at about a $360-ish profit right now. The long is from 390, right? So the long is from 390. We're trading below 390 right now. So we actually could move into the profit bubble a little further. I was able to hedge this, so I can stick with it this week and add to another one. I actually already added one, but we'll discuss these new trades here in a minute. The hedge was, I believe, a 402, and I hedged it for like 10 cents a piece. The 402s for like 10 cents a piece. So the hedge is there. My risk is absolutely limited, and I have a $310 credit now. Without the hedge, it's sitting at about a $360 profit. And that could go to $500-600 if we move up this week. And if we don't, then I will bank my credit and be happy, because it's like the 18th or 19th winner in a row from these calls. I do more trades outside of these calls, but from these calls, it's at like 18, 19 winners in a row. The 5-1, 4-1, 3-1 type option insanity trades that we've taken have been profitable. So we're going to be talking about this a little bit today, because one of the requests that I got is on knowing which week to go into. And so I'm going to use the principle. We're going to be talking about that principle and focusing on that principle today. It's called comparative principle, and it is, in my opinion, better than using the Greeks. And it's more logical, and it's more practical, and it's more realistic. Obviously, everything has projections, but we're gonna do the easy way. Many of you know, maybe some of you don't know. In the last, I used I used to look at Greeks back when I first started trading options, and you pick up a book, and of course everybody tells you, look at the Greeks, look at the Greeks, understand the Greeks, Greeks, delta, beta, alpha, theta, vega, all sorts of different ones, right? Well, along about 5 years into it, I said no more, and I haven't used a Greek to help determine a trade in, gosh, I guess it's been 25 years, close to that. Not necessary. If you understand what you're doing, you understand the principles behind what you're doing, how options work. Not necessary. Then that's not to say that they're not useful. I don't want to sit here and say that you can't be profitable using Greeks. You most certainly can. I'm just saying that there are simpler ways. That's it. And I prefer the simple way because I'm not that smart. So, yeah, I know some of you guys, you're probably like, I don't know. Listen, I was a solid in high school. I was a solid C student, and we'll just leave it at that. School was not something that I enjoyed a whole heck of a lot. Trading I enjoyed, and so I learned everything I could about it. And nonetheless, enough of that. Let's take a look at the option insanity before we get to the trades that exited on Friday. And of course, Friday the market did move down. Everything that we were in basically was profitable, except that one trade that I ended up getting out at a break even, or not a break even, a small loss on Thursday. Was not an official trade in this on this call, but it was a crazy calendar trade that I placed when the market was down, and I was being fairly aggressive in replacing a crazy calendar trade, and it went into the money. And that's the only loss that I had last week out of any of these trades. So it was another very good week. Nonetheless, let's take a look at option insanity. Where are my windows that I need to look at? There we are. All right. I'm going to move this over. We are going to take a look at my pattern spread generator. And the first thing we're going to look at is we're actually going to look at an 8-point 5-to-1 option insanity. So what is option insanity? Is anytime you sell the Monday option and buy the Friday. In principle, it's sell the further expiration option and buy the near-term expiration option. Create a spread, create a credit, and create a nice profit bubble or a nice projection chart. There are so many different ways to do an option insanity trade. It's really based on your imagination. You're limited only to your imagination and the opportunities that are available. And so one thing I like doing is the 5-to-1, and I like doing the 5-to-1 because it gives this huge profit bubble, and this profit bubble creates a little bit extra added layer of safety. I hesitate to use the word safety in this trade because technically you are essentially naked, five calls, because that's the way they're going to look at it in the margin. You actually have a hedge here on one, and then you have to have a margin hedge. And a margin hedge is where you go out of the money and you just pay 2 or 3 cents for 4 options or 5 options that expire on the short option expiration. That takes care of that reduces the margin significantly. However, these are structured so that in current market conditions, and I have to stress that if the markets tank, we're going to take a look at these trades, but I'm telling you, they are completely different. Then you have to be there. You just have to be different. You have to be aware of the different market conditions. So as of right now, with where things are at, this has been just a tremendous trade that we've been able to take. And as we've been at or near market all-time highs in SPY, I have opted to go with an 8 strike difference. And you can go with a 7 or a 6 or a 5 or whatever the case is, and you can create bigger credits. I go with 8. It's this long option that creates the bubble. A lot of people, the question was, why not just sell the options naked? Why have this long? Well, if you sell the options naked, you don't have the bubble. Okay, what do I mean by the bubble? I mean this. This is what I mean by the bubble. You don't have the bubble unless you have the one long. That's what creates the bubble, and that creates a little bit of an extra safety zone, a little bit higher profit potential if it moves into that bubble, and it's a tremendous little added benefit. So last week there was one trade that market was in the money. We were up $100 or whatever, but the other one was not up. If you didn't have the long, you weren't up. You were break even, maybe even a small loss. So that extra long here, it does serve a purpose, and it's a pretty good purpose. All right, so here's what I want you to notice. So this one right here, this is a short, okay? Short where we're at, basically. We're trading right now at 389.28. So we are right under where this short is, okay? And I'm going to bring this into a projection graph here in a second. But we're right at the short. Look at the credit. It's $667. That's the credit. And the whole thing is basically because, and this is one that expires this week, right? So this is Friday. This ends Friday. This Friday. And if you were neutral, you would actually see this go positive. You'd see this go to a debit by Friday because you don't have very much extrinsic value in the 382 call at all. And with the 390s, it's all extrinsic value, and it's almost $3 a piece, right? So the break even on the 390s a piece is at 393, and you'll be making a little bit at 393. You'll be making a little bit of money on that long, and so your break even is actually above 390. Let me back up. At 393 on Friday, the 390s will be worth more than 3 because there's a little bit of time value on them, but the break-even level holding on until expiration of the Monday option is 393, which we do not do. So I don't want to confuse you on that. We do exit this whole thing on Friday. All right, but this is what I wanted to show you. It's not necessarily the option insanity trade, but the process for determining what week you want to do a trade. And I do this for every single strategy that we talk about in this in these calls. And in order to know, okay, do I do it now? Do I do it the following week? Do I do it 2 weeks out, 3 weeks out, 4 weeks out, et cetera, et cetera. All right, so I already know that this trade is going to be worth, if the market goes nowhere, this trade is going to be worth $700 by the end of the week, more than $700 by the end of the week. Okay. If I were to, let's go to this one. If I were to go the following week out, here's the credit, 667 this week. Here's the credit for the following week. This is 3538, same strikes, 5 to 1. It's a 1075 credit. Okay, so how much is this spread worth if the market goes nowhere in 1 week? So if we visit this again next Monday and the market were to have gone nowhere, where would this spread be? Okay, it would have 1 week left, which means it would be equivalent to this trade right here, and this one has about $650. Is at a credit of $650. So we know that if the market goes nowhere, this 1075 will go about to 650 and we'll make $400. So this trade, this right here, has time value of $400 this week. Okay. What if we go the following week? Well, here's 312, 315, right? 312, 315. That is a little less than 3 weeks away, right? And the credit is at almost 16. And so I know that if I get into this trade this week, or right now, that I will pull in a $16 credit. And if the market goes nowhere in 1 week, that $16 credit will be worth about $10.75. So it's about $525 time value. Versus this week, which would be about $675. So there's about $400 time value on this one. And I know that by the end of this week, that if the market goes nowhere, I will have, this will be basically at a debit. And so I'll have almost $700. So right now, if I really wanted to take advantage of a neutral trade, I could take advantage of this one for about a $670 profit. And if the market tanks, I'm going to make $670. And if the market moves up, I will still make money up until maybe 394, 395, somewhere around there, which is when the short losses begin to offset the profit from the long. Okay. So that's a comparison. Now, obviously, I don't recommend doing these at the money because if the market does skyrocket, you have quite a bit of exposure because you're on the right side of the bubble. All right, so we're gonna take a look at this real quick, and I need to back out of some of these here because so we're gonna go 5-1, and that right there is based on a 312, 315. Okay, so that's a 5-1. Actually, let me rephrase that and refresh that. All right, so here's the 5-1. And it's at a credit. This one's showing 719. So credit of 17, basically. It's $1,700. That means if the market stays the same over the next couple of weeks, you're going to make $1,700. If the market tanks, you're going to make $1,700. You'll notice that we're on the right side. We're starting on the right side. This is not the profit bubble that we're talking about because we're on the right side of the P&L, and we've got $1,700 in credit. So that's what creates the difference. Here's the break-even point. It is actually, that is going to be much different. So let me change this. There we go. The break-even point on this one is estimated at about 395.5, 396, somewhere in there. So it's a neutral trade, but there's a lot of time for this market to move to 395, 396, et cetera, et cetera. You go out here all the way to 401, and you're projected to lose almost $2,000. So about the same. That's where your 1-1 win-loss ratio is. So if the market stays the same, you make basically $2,000. If the market moves down, you make $2,000. If the market moves up all the way to 395, you'll still make some money, and you don't lose $2,000 until the market moves to about 401. That's going to be pretty accurate. The long-term probabilities on this are absolutely positive. They're in your favor. You're just risking a little bit bigger amount on a move up. And I'm going to be honest with you, I believe that they are going to push this probably next week. March 1st, by the way, which is on a Monday. March 1st is one of the most bullish days of the year. The first calendar day, first of all, is the most bullish seasonal that I know of. First calendar day of every month. February and August are a little iffy depending on market action, what's going on. But the rest of the time, The first calendar day of the month almost beats the total return of the market of the buy and hold since the mid 1980s. Little valuable tidbit there for you guys if you haven't or if you're new. So I am going to be cautious with this, but I wanted to show you the difference between uh, uh, getting a big credit and a small credit and the price comparisons between the two, et cetera, right? So we're going to scroll down now and we're going to start looking at out of the money. And we're going to see how far we can get a credit with this week's. So here is a 385, 393, and that's a credit of $1.52. And if we go, let's see, 387, 395. That's the last. You can't get a credit on a 387, 395 for this week. Okay. Now I want you to notice that we're going to look at the 387s and 395s. This is the principle. This is the comparative principle. What is this 387? If I go 3538, what's it going to be worth in 1 week? We know it's going to be worth about 8 cents if the market goes nowhere. Right, so we're going to look at the 338, 387, and 395. Look at that, it's a 390. Okay, this is 3538. So this is 2 weeks out. This spread is worth, and it's you're kind of like not quite in the middle of the profit bubble, but you're getting close. You're looking at a almost $400 credit. And so we know that this trade is worth about $400 over the next 1 week period if the market goes nowhere. Okay, let's go to the next expiration, which is 312, 315. Go down to 387, 395. Look at that one. That one's 811. So we know that the next week is also if the market stays the same for 1 week, we know that this one will go down to about a $4 credit, and we'll have about $400 in profits on that one. Right, so you can see that there's really not much difference between if you're due to 387, 395. So the question is, which one would you do? Personally, I would probably look to do this one since they're about equal, right? So this one is worth about $400. And then this one is worth about $400 because in 1 week, even though this is 2 weeks out, we know that if the market goes nowhere, it's going to drop to about a $4 credit. So they're both worth about $400 where it is. And then this one, which is a debit, right? So this one is a debit. This one in 1 week, which is not 1 week actually, but by this Friday, if the market is still trading here, is going to be worth about $300 to $400 debit, right? So I could still do this one and create a debit, a small debit, but that just means that I would lose a little bit of money if the market absolutely crashed. $5, $8, whatever it is, my debit, that's the risk to the downside. And we don't have a lot of time for the market to make another big move to the upside. It's certainly possible. But in this case, the break even is going to be just over 395-ish, 396-ish, somewhere around there. Maybe a little bit higher than that. And so you've got that buffer there. So the question is, do you want to create a credit? Do you think the market's going to go down? Or do you think the market's going to go up? Are you more favorable? Do you need to have a bigger credit? Do you need to make more money because you long stock? And so, if the market goes up, your stock portfolio is going to be great. At which point, if the market moves down, you'd want to make more money. Then I would do the further week out, because if the market moves down, guess what? This is going to go to zero faster. Or it's going to go to zero. It's going to go to zero faster. But when it goes to zero, you have $800 in profits. Whereas if the market tanks and you're in this one, the max profit that you're going to have on the downside is $400, right? that's how you make the decision on this type of deal. Now, personally, these are way too close to the money for me, especially given what I just told you. I don't trade according to the seasonals with regard to this strategy, but I do reference them, and I may alter the trade that I end up taking because of them. And so personally, I would go further out of the money. So here's a 390, 398. This is one that I am currently in that expires this week. But I'm in this one from, I'm in this particular spread from a credit of 350. And so this one is certainly possible. The question is, do I do this one or do I do the next one? And I already know, by the way, that if I do this one and the market goes nowhere in 1 week, this 133 credit is going to be worth about $350 debit. Because that's, or actually not $350 debit. It's going to be, it's actually going to be worth about zero. Let me go to 390. So this is the one I'm in right now. It's worth about $1.75. Okay, again, I'm in at a credit of 350. Okay, in a credit 350, it's at 78. That means I'm making about $425 on the trade. All right, this trade right here, the following week is, whoops, for the following week is at a $1.33 credit. So I can get, if I go with a $1.33 and the market goes nowhere, then I know I'm going to be making about $200 on this trade next week. Okay, however, again, the market could easily move up to 398, 399, 400, somewhere around there. I think they're going to push 400. I think they're going to push for 400. And so again, I'm looking at going further out. And you'll notice here that on 3538, you can't go out very far and still bring a credit. You can bring a 9-cent credit on a 394.402. I really don't trade these for no credits. I definitely want a credit. So the question is, do I go further in the money or do I go further 1 week out? All right, so this one, if I do a 394.402, the break-even level on this trade is going to be around 402, 403, somewhere around there. And it's going to be a nice profit bubble. If the market moves up to 398, 399, by this time next week, we're going to be right in the middle of the profit bubble. It's going to look really good. And obviously it'll be, by this time next week, will be the first. And so the first calendar day will have been pretty much done with. All right. So I want a bigger credit though. So if I go one more week out and I do the 394.402, instead of a 9-cent credit, I can bring in a $1.70 credit. Now, granted, that'll give me one more week, but at the same time, it also gives me the opportunity to potentially hedge at that point as well. Plus, if I want to go a week out and I want to go further credit, I can do that. I can get a dollar credit by going 396.404s. All right, that's comparison. I cannot do a 396.404 and bring in a credit by going with 3538 expiration. Okay. All right, so let's just get all fancy here and compare the next one as well. And so I'm going to go reset spreads, and we're going to go 319, 322. So that's a full month out, and this is about as far out as I will place them. Is about a month out. You can see that they are they're worth these at the monies. They're worth about $500-600 a week, pretty consistently, right? Because this one's trading at a $2,100 credit. But I have a full month, and so that's a lot of time for the market to make a pretty big move to the upside. So I would not ever do this particular trade. But I'll generate the spreads, and then we'll take a look at that as well. So how far can I go out and still bring in a $1 credit? If I go 4 weeks out, 400, 408, and I can bring in a dollar credit. That's pretty good. That's a nice profit bubble at the 404, 405, 406 area. The break-even level is going to be around 410. Sure, it's a month out, but we've been trading at all-time highs here, pretty close. I think they're going to push it again, and once they push it, whether it continues or not is anyone's guess. All right, but that's the comparison method. All right, now having said that, what I want to do is I want to talk about doing a smaller ratio. And then we're going to go into crazy calendars. So I'm going to do this real quick. Reset spreads, and I'm going to go 3. Not 1. This is a 3. 3 to 1. And you'll notice here that a 3 to 1 gives me a $2.80 credit on basically at the money. Okay. And the credits go away pretty fast. This is 3.538. Right. So credit on this 3 to 1 is at 27 cents with the 386, 394. And then we're going to go 1 week out. Actually, I'm going to change it on this one. So let's go 312, 315. Look at the same thing. And this just basically goes another week out. And again, 3 to 1. That reduces the risk. It reduces the margin required on the trade. And you're looking at a $610 credit with an at the money. How far can we go? We can go all the way out to about 391, 399 and still create a credit. All right. So let's take a look at this for a second, because what I want to do is I want to talk about how to hedge this thing. I'm going to talk about how to hedge it from the beginning so that you don't have the big risk, and some of you can go a little bit bigger on these. So I'm talking about this because of the compounding ability. You have the ability to compound these faster so long as the margin allows, right? So you do have to have enough margin. Your compounding can't be faster than the margin. Eventually the two cross over. But here is a 3 to 1, 382, 390, 312, 315 expiration, almost a $600 credit. You can see here, nice big profit bubble. We're right in the middle of the profit bubble. That's where the 390 is. The break even is actually around 397. And then the loss, by the time you get to 400, it's not that big compared to your profit potential, because you're going to make $586 if the market moves down no matter what, right? And so, what can you do to cap this to make sure that you never have to take a big loss on this trade? And the answer is you simply buy a call, right, on the other side of it somewhere. And we're just going to throw a 400 in there right now. Now we're in a 1 to 2, right? We're in a 1 to 2. The 400s are actually going for about $1.08, and so I can still create a credit by completely hedging this with the 400s. And let me update that. That's one. So one complaint I have about the portfolios. All right. So here we have a scenario where you're going to make $400 if the market moves down. You're going to make $800 or thereabouts if the market stays the same. And if the market skyrockets, with this particular trade, you're going to lose $800. Okay, if it goes above 400. So you have about on this particular trade, if you hold on until expiration, you have about, I want to say it's about a 30% shot at getting up to the 400 level and closing at 400 or above with this trade. So it's not the best scenario in the world, but the probabilities are well in your favor. The average win-loss ratio, okay, the average, not the absolute, but so not the max versus the max gain is about 1-to-1 versus the max loss. So I want to talk about the average. The average is going to be positive because of the large credit and the lower probability that the market is going to go into these larger risk levels. So this one is a trade that absolutely has positive probabilities, but you're going to lose you're going to hit the max loss if the distributions are correct, if the probabilities are correct, about 30% of the time in this particular situation. All right, but the key is to make sure that you have a significant credit on the trade. You can drop this, by the way, to a 2, but at that point you create, let's refresh this here. You can drop it to a 2 and you can have one hedge and you're going to have a nice big profit bubble, but you have an 86-cent debit. But your risk to the upside is only $250. Not a bad trade at all. I don't like the $86 debit though. That's just it's a thing of mine. I don't like it, and so there are several things you can do. You'll increase the risk a little bit, but for example, I may go with a 383 call instead of a 382, so I'll pay less for it. And then that increases my risk a little bit. Let me update this. And there. So now I have no risk to the downside. I have a nice big profit bubble. And my max risk to the upside is $303. All right. Anyone can place on this trade if you have a big enough account to deal with the margin on this trade. And there are all sorts of ways to make this trade create a little bit more of a credit on this trade as well. But I just did something simple in raising that long leg. And I have a nice profit bubble of about 500 and a max risk of about 300. And I have about a 30% shot of seeing that max risk with this trade. But let's do this one now on the, let's see here. Let's take a look at this one. So I'm going to do a, what did I drop that down to 2? I think I did. I dropped it down to a 2. Yep. So we're going to go a 2 lot, and we're going to make this an 83. And holy cow, where does time go on these calls? I mean, seriously. Yeah, 83, perfect. And I'll reset those. And then I'm going to add one, and I'm going to add the 400. And this is 226.31, so I'm going to add the 226.400 is what I'm going to do. And so we'll go here, 400. All right. Now, this one expires this week. This is basically at the money. We're going to go ahead and generate the spreads. So this is the 121. We've talked about the 121 before. I'm just going out a little bit further and going out a little bit bigger on the on the spread. So this is with a 312, 315, 312. We're talking about basically almost a credit cost of 0, right? So that's the same thing. Same thing. So this week, right now, where it's at right now is at $1.93. That's $1.93 debit. So if I get into this trade, the 312, 35, I know that in 2 weeks I'm going to be making about $200 on this trade if the market goes nowhere. Okay, everybody see that? All right. So where do you see a credit on this thing? You don't, right? You don't see a credit as far out of the money as we want to go. And so we know if I can bring in a credit on this thing, that I have a pretty high probability of let's see, what's the biggest debit? Looks to be about 218. And that's with the 392. So 385, 392. So that one is good. Now let's take a look at the 312, 315, and 312. All right, so this is the one that I have on right here. This is that one at a, basically it says debit of 3. We can probably get a credit on this. So yeah, that's this one, showing a debit of 3. And where is, so this one, we won't be able to get, what, did I hit reset? Yep, I did. Here, let me hit reset. All right, so on this one, kind of the same thing. We're about where, as far as we can go before we get a credit, and why did it not update on all of the others? There we go. Here are the debits on all of the others. So we're looking at about $1, $1.03, $1.06. So about $1.06 is the biggest debit that we've got. So we can't get, I mean, this is as close as we can get and to a credit with this particular pattern going that far out. One more week and then we'll move on. 319. Basically, I'm just showing you how to structure some of these to have a little bit less risk, a little bit less margin requirement. I'm going to reset and generate. So you'll notice this one only has, it's a credit of 7 cents. What does that tell you? 319, 322, 319, only a credit of 7 cents. What does that tell you? It tells you that this trade over the next week is only worth about $7. So guess what I'm not going to do? If I were to take this pattern, and I've decided these are the strikes I'm going to do, I know I would not do a 319, 322, 319 because it's not worth anything over the next week, right? That's how you know. And in fact, again, you can't get a credit really on anything. And they are trading at a debit. So any movement down, you're going to see an immediate debit on these trades. It's basically what this is saying. Any movement down, you're going to see immediate debit on the trades. And as it moves higher and as time goes on, you're going to start to see a profit on this trade. And we'll take a look at this one that expires this week on Thursday, see where it's at. All right, let's move on. Hopefully everybody understands how I compare the different prices of the option spreads going on a week-by-week basis to know how far out I look and how far out I can look. If they're pretty much equal, the bigger credit is the one that's going to make more money if the market moves down, right? And if you're not necessarily looking for the market to move down and you're looking for a higher probability, then you go with a smaller credit and a closer expiration as far as 5-to-1 option sanity is concerned. Okay. Now, as I told you, there are many option insanity different patterns. Yes, I do. I am planning on putting all of these in some sort of reference manual at some point. It's a lot of work, but we'll get to it. This is one that I was filled at on 217. We talked about this on Thursday. The market ended up closing at around 393, 89, but it was the market had moved down, and so there was a little bit more volatility. The options were holding on to their value a little bit more, and so what I did is I just went ahead and got out about midday at a $28 profit. It's something simple. Because I didn't know if it was going to move all the way back down or back up to 392, at which point, or 393, at which point it would produce a loss. And it was just something that I had there to produce a small profit based on a different scenario. I trade these in conjunction, in a synergistic type way, if you will, with other trades. So, for example, I also had on this trade, and I had on this trade at filled at a credit of 167. And I did that also in case the market moved up to 393. I'd have a small profit there to offset this one, right? And then here is where the risk was, and that's where a profit bubble was on this one. And I ended up getting out of this one at break even because the market was trading right at 390, and so that was my risk level. So I just got out of that at a break even. Right. So that's one of them I put on Thursday, one of them I put on Wednesday. These are just some 1-1 options, really short-term option insanity 1-1 trades. Because how do I know I can do them short-term? Because I can't get better prices if I go a week out. So there's no reason necessarily, unless I want to give the market more time to make the move into the profit zone. But usually I can't get as good of prices. And so I know on these types of option insanity trades, I'm better off doing them on Wednesday or Thursday, literally with 2 days left to go. Okay. Here is a crazy calendar trade that we had placed on 219, 222. And this is one that I placed on at a credit of 50 cents. And it's also one that I exited on Thursday at, I believe it was a $75 or $78 profit. As opposed to holding on until Friday. As most of you know by now, rarely will I hold on to these crazy calendar trades until expiration day because of that volatility drop that we expect, which is what creates the profit potential in these trades, right? So I am normally getting out by Thursday, unless I have a loss and the market could end up moving back into the profit zone. Then I may hold it until Friday. Or if I have the credit and there's really nothing, I'm going to make the credit and there's only nothing but good if the market moves up on Friday, if I can only increase my profit potential. Right. But on this one, about a $75 profit. Here's one very similar, is 398, 398, 390, 393, 398. And then my calendars were at 395s, right? So I had a credit spread at 393 and 398. And I specifically did that to create a bigger credit. And then I had 3 calendars, 395s. And on this trade, I ended up making $80 because I exited on this one on Thursday, as I mentioned as well, and told everybody there's no reason to hold on to this trade past Thursday, just simply because the EMR, the equal movement ratio. If the market moved up 2 points, I'd make another $50. If the market moved down 2 points, I might lose $50 or a $50 smaller profit, right? So there's really not a lot. If you're going to go for the small profits, you got to take the profits, right? We're not going for the big, huge profits. And so that That is something that happened. The other one that we started looking at is based on this week. And we started looking at risk-free calendars. And you'll notice that we got into this risk-free calendar, or not risk-free calendar. We got into the core trade with the intention of producing some risk-free calendars. And if you, I'm not going to do anything to explain those today in today's calls. I would suggest going back to the previous two recordings, specifically 1 week ago, and then again today's, or excuse me, last Thursday's, and start looking at those. But this is where we're at with these right now. I ended up doing the core trade, got filled at $1 credit, and then at that point I was able to add a March 400 call, and then I sold a February 26th 400 call, and then I bought a March 1st 400 call, and then I sold a February 26th 400 call. So that's the process that I used. Because of how the market opened on some of these, I actually ended up having a credit on my calendars and creating an overall credit on the entire trade. And then I exited, and this was done on Thursday. I exited the core trade, or part of the core trade, I should say. I exited the 396 short and the 401 long. One 401 long, not all three. One 401 long. That left me with 5 400s that I'm short, 3 400s that I was long, and 2 401s that I was long. Okay. And this is what this created by exiting that one credit spread. Created a very solid trade to the upside. So I hope the market moves up for the sake of this trade this week. But if it doesn't, I have a credit. And it is something that is very, very usable. I haven't done anything else because we've moved far enough away that I can't really buy or sell anything. I just have to hold on to this trade and not do anything else with it. And just hold on to it. Wait to see if the market moves up. Okay. We did another one on Monday, and this is the one that we did: a 3538, 397, 401, 402. That was the core trade. We were filled at 108 on the call, and then I had an order to then buy the 401, and that's 38. That creates the one calendar, right? One risk-free calendar. So bought the 308 expiration 401 call for 93 cents. This was not filled on Thursday. It was filled on Friday. And so I was able to do that. However, and I did buy it at 93 cents. And that gave me a small, an overall credit on the trade of about 15 cents. But the market has moved down, hasn't moved back up. I have not been able to resell the 401 call. So now I basically have this trade on at a 15-cent credit and waiting for something to happen. If the market moves up, great. I'll have an opportunity to sell that. If it doesn't, then I've got a small credit on the trade. Okay. Now let's take a look at crazy calendars that might exist right now, because I do expect the market to move higher. And we talked about, by the way, I talked about putting some of these trades on with no other reason than creating a small profit, a small credit. You don't have to do the whole creating the credit, the risk-free calendars. Here's the core trade that you could have put on Monday at a credit of 55 cents. If you're only going for $20, you have a very high probability of realizing a $20 profit on this thing, because it was out of the money. Market was trading at 390-ish on Friday. Is out of the money, and you actually had a slight bump at the 401 area, right? So your break even was right, just above 401. And that's a pretty big move for 1 week, considering what's what has gone on. So this one, very high probability. You don't even have to do anything else. You just put on the trade as a credit, and let it go, right? So put a target on it at $40 profit, $50 profit, something somewhere along those lines. Okay, let's take a look at risk-free calendars that exist. Whoops, right now. Where's my window? Here it is. And all right. So we're going to take a look at this. And what I'm going to do is I'm just going to, I know this says 5-1 option standing. I'm going to steal it. All right, so I'm going to continue with the credits, even though I think the market is going to move up, especially on Monday of next week. And that starts, by the way, Friday's close. And I'll mention this on Thursday, wherever we're trading at. I'm going to mention the first calendar day of the month again on Thursday. But we're going to go with, let's see here. We're going to look at 3, 5, 3, 8. Whoops. 3, 5, and 3, 8. And I'm going to go. I'm going to go with, actually, you know what? Let's just look at all of them. 390, 395, and 393s will be my calendars. All right. So we're going to go 3 calendars like normal right now and see if we can't bring in. So this is a credit. So this is not out of the money. I absolutely am going to go out of the money if I do one of these. So we're going to go 391, and then we're going to look at all the way up to 410, basically. All right. So this is a credit spread combined with 3 calendars that don't expire this week, but expire the following week. And we're going to see how far we can go get a credit on these. And we can go 397, 402s, and the 400s are the calendars. I actually like that one. And you can get those for a credit of 20 cents. I do actually like this one. You're not going to make a lot if the market stays the same or moves down, but if the market moves up, you've got a pretty high probability of being able to pull out a decent profit at around 400. And go all the way to maybe 400, 405s, 403s. You can pull in a small credit. Okay, so that's 3.5, 3.5, 3.8. With the following week, which getting a little bit further out, but we're going to do this just to compare prices. And we'll generate these. And we can go out all the way to 400, 405, and do 403 calendars and still do a 22-cent credit. So these are pretty high probability at this point. They're not super high probability, but they are pretty high probability. We're gonna have resistance at 4. I mean, if they push it to 4, which I think they're gonna do. Yeah, I think we'll see a little bit of resistance there. So that puts this 403 pretty safe. We've got the long 405. That's about where the break even is going to be, maybe slightly less than that on this particular example. So we've got a long way for the market to have to go, and we've got a nice credit here 20, 21 cents if I were to do that one. You'll notice here that these calendars also, they're 58 and 76 cents. If I wanted to, I could actually do 4 calendars in this scenario, which creates a bigger profit peak and still get about a credit, well, hopefully get a credit of 6 cents. That's a pretty big bid-ask spread, pretty big wide bid-ask spread. But if you can get that for a credit of 6 cents and you're not expecting to make anything to the downside, you've got a pretty nice trade at that point, because as the market moves up, you're going to start seeing these calendars increase in their price. All right. Let's check the question. I know I'm over, but wanted to really go over the comparison stuff today. So Stefan, let's see. I use UVXY hedge from your hedging webinar. Thus, any significant move down is taken care of by this hedge. This makes me think I want to design TPO trades to bullish bias. Is there a correct assumption? If that's what you want to do, if that's what you want to achieve, there's no problem. So somebody uses a hedging process, but the it totally depends on the cost of your hedges, because what you don't want to do is you don't want the market to just kind of sit there and your hedge starts costing you money and you're not making anything in the TPO. So you just got to be careful with that. Being smaller accounts can't trade option sanity. It would be nice not to spend it. So how small account are you talking, Mark? Because you can trade, you can trade these with a $5,000 account. Some of these trades, the option sanity trades. So that's the majority of the people here are able to trade in a $5,000 account. And it's the one that's the best producing right now. So the TPO is based on what strategies are producing the best opportunities, and option insanity are by far the best opportunities. I understand, with regard to the compounding, they're not the best with regard to compounding, but they do help in cross compounding. Trader to fill in. Let's see how much margin for the 1-2 insanity. So it's going to be, depending on how far out you go with the margin hedge, it's going to be like $4,000 to $5,000 minimum. If you on the ones that we talked about today, which would be this one, the margin would be, let's see, 390s, 390. You're probably gonna have to go to about 420, and that would be about a $6,000 margin if you go this far out in time. The closer you are in time, the less margin, because you can go closer with the margin hedge. Let's see. I'm offering the time to create the manual for these strategies. 979 Sunset. I want you to email me, RyanQTT@gmail. I'm a Canadian living in Cayman Islands. Oh, Eric, way to just rub it in. So Eric, it's not, they don't have a, TradeR does not have a policy of not having foreign clients. They are limited by their clearing firm, and they're working on being able to be more lenient, but they do accept foreign clients. My suggestion is call them and say, I know you've got some clients. What do I need to do to meet the requirements. John, I, for one, appreciate these deep dive webinars going into your thought process in depth on one trade pattern. Great. Glad you find that helpful. What happens with option insanity trades if the market tanks? How different will you be trading them? It totally depends on the pricing structure, but I'll give you an example of last year, Derek. When the markets tanked, I was still able to get some option insanity trades that were like 40 and 50 points out of the money and create credits. I kid you not. So it depends on, how much the market moves down and some other factors, but you can still do it. Well, we'll just leave it at that. It's hard to say exactly because we don't know what the pricing is going to be like, right? So if that happens, believe me, we'll cover it. The 5-1 insanity trade is a nice way to offset the cost of holding put hedges in a big stock portfolio. Yes, it is. That's exactly right. Alrighty, 979 Sunset. I will shoot you an email. Let's see here. Alrighty. What's your opinion of Robinhood with these strategies? I don't trade through Robinhood. Trade Partner is not hooked up to Robinhood. I don't think Trade Partner can be hooked up to Robinhood. I don't think they provide the API access, and I'm almost for certain that Robinhood has bigger clear, quote unquote, clearing costs. Don't quote me on that. You might want to check into that and see. All right. Looks like I got all of the questions. All right, having said that, then we will go ahead and end, and I will see you guys on Thursday. And Mark, I know you really want to spend more time on the crazy calendars, but I spent so much time on them over the past few months. But I promise I will spend more time on crazy calendars on Thursday. All right, guys, that is it for today. Have a good day.